Hello guys, what's up? I know it's been so long since I've posted, almost 2 months, and I'll be working on this consistency about the posting content thing. And I'll be starting off with the market structure series, which will be basically a three-part series where we'll be discussing parts of market structure. And for the first part today, we'll be discussing break of structure and market structure shifts. So let's jump right into it. So, what is market structure? One of the most crucial concepts to comprehend while participating in markets and understanding price action is market structure. In essence, it is the way that price fluctuates throughout time. Any charts will show you that the price moves in waves going up and down again. We refer to the pattern that these movements produce as market structure. With the understanding of market structure, you can comprehend price action better and determine if the market is heading sideways, upwards, or downwards, which will help you decide what to do next. Understanding market structures needs a lot of pieces to put this puzzle together. Concepts like break of structure, market structure shifts, inducement, swing highs and lows, time frame alignments, liquidity sweeps, and advanced market swings will give us a better understanding while framing a narrative on every time frame. So, what is a swing high? The price point on a chart when the price peaks and then starts to fall is a swing high, which is a very vague description. But a swing high needs to be supported by later price action in order to be considered legitimate. Price should move lower after reaching that swing high point, and swing highs can usually act like resistance. So, basically, what it means is that when the price will return to the swing high level, it may struggle to break above it. So this is an example of a swing high. A swing high occurs when the high of the first candle and the second and the third candle, the high of the first candle and the third candle is lower than the high of the second candle. In a three candle arrangement, the high of the second candle is called the swing high. Similarly, on swing lows, in a market, a swing low is a price point where the price hits a low and then starts to increase. A swing low must be supported by subsequent movement in order to be considered legitimate. A low swing might provide a measure of support, which basically means that there is a chance that price will find it difficult to break below the level once it returns there. This is an example of a swing low, and in a swing low, the low of the first candle and the third candle is higher than the low of the second candle. In this three candle configuration, the low of the second candle is called the swing low. Now moving on to the break of structure. Break of structure is basically a continuation of market trend by breaking its previous structure. Break of structure helps us to catch continuation trades in the market, and it also helps us identify the market trend. A break of structure occurs when price breaks a key recent high in an uptrend or a key recent low in a downtrend, and it confirms trend continuation, while the BOS strengthens the ongoing trend's momentum. Price doesn't move straight, it always makes pullbacks and corrections. These retracements might include inducement zones or liquidity zones that are taken before the BOS occurs. And inducement zones are nothing but liquidity pools which are swept before price resumes its trend continuation. I will be explaining liquidity pools, inducement zones, and liquidity sweeps in depth in the second part of the market structure series video. But basically, what we have to keep in mind as of now is that a BOS which occurs after a inducement zone is swept or taken is a stronger BOS as compared to a BOS that occurs without any inducement zone. That's all. So we have two types of break of structures. The first one being a bullish break of structure, which basically in an existing bullish trend clearly showing higher highs and higher lows, price breaks a recent high with a strong bullish displacement move. This break indicates that buyers are still in control over sellers, signaling a potential bullish trend continuation. We might see a liquidity sweep or a grab of recent lows, or a tap into liquidity pools leaving behind strong lows, order blocks formation near displacement origin, and fair value gaps being held before break and close above previous highs. As you can see, this is a good depiction of a bullish break of structure where we have a clear bullish trend forming a recent high, and then we form a higher low, a higher low, which finds support in the trend, and then price shows displacement, strong bullish displacement, closing above the recent high, forming a new higher high, and thus giving us a bullish breakup structure. Similarly, the bearish breakup structure happens in an existing bearish trend which clearly has lower highs and lower lows, where price breaks a recent lower low with a strong bearish displacement move. This break indicates that sellers are still in control over buyers, signaling a potential bearish trend continuation. We might see a liquidity sweep or a grab of recent highs, or a tap into liquidity pools leaving behind strong highs. Order blocks being formed near displacement origin and fair value gaps being held before break and close below previous lows. So this is again a bearish trend, clear bearish trend, where we form a recent low and then price retraces back into the bearish leg and forms a lower high, and then it finds support in the recent bearish leg, and the price is pushed down with strong bearish displacement, forming a new lower low and closing above the recent low, thus giving a bearish breakup structure. Now we move on to the market structure shift. So market structure shift is a reversal signal in markets that indicates a change in trend. A change in market structure helps in identifying possible market trend reversals and helps us formulate reversal ideas. When the price breaches and closes below a recent low in an uptrend, or closes above a recent high in a downtrend, the market structure shifts. MSS weakens and reverses the momentum of the current trend while confirming trend reversal. In contrast to brief reversals or pullbacks in patterns, MSS indicates a more stronger, significant, and frequently long-lasting shift in trend. Depending on the time frame examined, MSS might show either a short-term or a long-term trend reversal. Now again, we have two types of market structure shifts. First one being the bullish market structure shift, which basically in an existing bearish trend, clearly depicted by lower lows and lower highs, price breaks a recent lower high with a strong bullish displacement move. This break indicates that buyers have overpowered sellers, signaling a potential bullish trend. We might see a liquidity sweep or a grab of recent lows leaving behind strong lows. Order block formation near displacement origin, breaker block rejections, or a fill and reaction from fair value gaps. So basically, this is an example of a bullish market structure shift where we are in a clear downtrend and we have a recent low and price forms a lower high, but then price sweeps this recent low, forming a lower low, and after the sweep of this recent low, price gains momentum to the upside, has strong bullish displacement, and strong enough to close above this lower high, forming a new higher high and thus creating a bullish market structure shift. In this process, the price will usually leaves behind fair value gaps in this displacement leg, as well as leaving behind order blocks, which further acts on as a region of support. Similarly, in bearish market structure shifts, in an existing bullish trend, which is clearly shown by higher lows and higher highs, price breaks a recent higher low with a strong bearish displacement move. This break indicates that sellers have overpowered buyers, signaling a potential bearish trend. We might see a liquidity sweep or grab of recent highs, leaving behind strong lows, order block formation near displacement origin, breaker block rejections, or a fill and reaction from a fair value gap. As we can clearly see here, we have a bullish trend existing. We form a higher low and then a higher high, but this higher high sweeps these recent highs formed, and after the sweep, price gains momentum to the downside and we see strong bearish displacement, so strong that it creates a new lower low by closing below these higher lows and thus creating a bearish market structure shift. Obviously, due to this strong displacement, bearish displacement leg, it will leave behind a lot of bearish arrays in the process, which will further act as resistance zones for price. Now moving on to the importance of fractals and time frame alignment. So markets fractal nature refers to the concept that similar price action patterns and structure repeats across different time frames. One thing that we should look for in the market is that we must distinguish between major and minor structure. Fractal nature of markets always allows the trader to analyze the market structure on smaller time frames. Market structure is often analyzed on higher time frames in order to understand the overall context of the market, but the analysis on lower time frames help us in the execution part of our context that we have gained on the higher time frames. Each recent price swing is analyzed on a smaller time frame, thus for understanding of minor structure. So time frame alignment is the key to implementing a lot of various concepts that we have just discussed, like break of structures and market structure shifts, along with other concepts that I have described in my previous videos, like AMD models or market maker models, or external range liquidity to internal range liquidity moves, or vice versa. And it helps us to translate higher time frame ideas to intermediate time frame and intermediate time frame ideas to the lower time frames for execution. When we have the bias on the higher time frame, which is the why for our prices, and the intermediate time frame presents the how the prices will move towards the drawn liquidity, it becomes easier to understand the when, which shows when to get into the positions on the lower time frame. Moving on to the examples now. Here we are looking at the dollar index on the daily time frame. We can see clear lower highs and lower lows on this chart, giving us a clear downtrend, and we will be looking for the continuation of the same. Always remember that the trend is your friend. Keep following it as long as you are proven wrong. Most traders find themselves in a losing streak because they are trying to predict the exact reversal point, whereas you should be focusing on staying with the trend. Now moving back to the charts, as we can see, we have two examples of break of structures here. The first one is an example of BOS with an inducement zone. As you can clearly see, we have double swept these highs, which was our key liquidity pool, and the price reacted strongly from that inducement zone and displaced below the recent lows with strong bearish candles. As we can see here, the displacement alone gives us conviction, which is also backed by bearish arrays being left behind, such as this order block and this FVG. The second break of structure here that we discuss is without any inducement. You can clearly see that price has retraced back inside the order block and the fair value gap left behind and reacted strongly with significant displacement off of it, closing below the recent lower lows and giving us a clean break of structure. Now for the second example, we have a gold chart on the 4-hour time frame to basically show that these concepts are fractal and applicable on all the time frames, the daily, the 4-hour, hourly, 15-minute, everywhere you can find these concepts and apply it to your benefit. We can see clear higher highs and higher lows being formed, and this is a clear uptrend without any doubt. And here again we have two examples of bullish break of structures. Both the break of structures are after taking the inducement zones. So we have support zones here, which is our 4-hour order block, and we have the suspended lows, which are the inducement zones. Price has swept these inducement zones and reacted strongly off of it, closing above these higher highs and thus giving us a bullish break of structure. Similarly, in this region, we have a 4-hour refined order block, which was refined from this bullish daily order block, and we have this low, unswept low, which is also a part of our inducement zone. Price again swept this low, got strong rejection off of it, and closed above previous higher high with very strong displacement, again giving a bullish break of structure. Now we are on the daily time frame of the Euro USD chart, and here we have multiple examples. As we can see, price was in a clear uptrend with higher highs and higher lows, and multiple break of structures before it failed to close above its recent higher high, and we see a sweep of these highs instead. The price reacted strongly from these highs, going down with strong displacement, leaving behind bearish PDRAs. As we can see, after these highs were swept, we left behind bearish PDRAs, this bearish order block overlapping with a bearish daily fair value gap, and you can clearly see a cluster of strong down close candles here, showing displacement as price broke the recent lows and closed below them, creating lower highs and lower lows, giving a market structure shift and thus indicating a reversal in trend. In the same chart, we have a bearish BOS example, which is without any inducement, as we have established that the trend was reversed after that market structure shift here. The price continued moving lower, creating lower highs and lower lows. So this is your lower low and this is your lower high. Here we can see the price retraced a little before closing below the recent lower lows, leaving behind overlapping bearish PDRAs. And look at the displacement here in price, giving us more conviction towards the bearish trend. In our final example, we show multi-time frame analysis on NAS and how multi-time frame analysis can be used along with fractals, and these concepts can be applied to create a better understanding of your narrative and the context. So on the weekly we are here, we can see that we have been in a clear uptrend for a while and price has retraced back. Obviously we have been in an uptrend. This is a lower low. This is a higher high, this is a higher low, then again higher low, higher high, and following, and then we have created a strong higher low where price has found support. Price has found support on this weekly fair value gap, and price has reacted very strongly off of it, so strong that it has closed above the previous higher highs. Now we move on to the 4-hour chart and we'll see that how fractals are so important, because on the weekly we saw that we were in a consolidation phase after a clear uptrend move, but here we can see that in this particular leg of price action we are in a clear downtrend, and price when tapped into that weekly fair value gap, which was our support level, bullish support level, price swept the lows, held these lows and reacted so strongly off of it. These are lower high, lower low, lower high, lower low, lower high, lower low, and here the last lower low was created, after which price closed above this lower high, creating a new higher high. And look at the bullish PDRAs that it has left behind. Obviously the 4-hour order block has been left behind with an overlapping 4-hour fair value gap, both being bullish, both being left behind, and both being tested and held by the price action while pushing price further, thus giving us an even further confirmation that the price has reversed its trend. As you can clearly see, look at this price leg, how these strong bullish candles have displaced after taking out these lows and given us a market structure, a bullish market structure shift. So that's it for today's video. We discussed the basics of market structure, covering the swing highs, swing lows, along with break of structures and market structure shifts, along with the understanding of price on fractals and time frame alignments. We discussed all of them with appropriate examples, and we briefly discussed inducement zones and liquidity pools as well, which will be further discussed in depth in the next video along with the liquidity sweeps. Till then, let time do its heavy lifting. Stay safe, happy trading, bye.